I hope everyone is doing well. I'm Eric Jess, Chief Development Officer and partner of Medix Dental IT. A quick overview on our company for those listening in for the first time. Medix Dental IT is a strategic partner for dental professionals all over the U.S. that are wanting to be more successful and profitable by streamlining their IT operations. It's kind of like a dental treatment plan is a detailed oral health plan for patients. Our IT treatment plan is a comprehensive technology plan for our partners. This plan involves aligning your technology and strategy with your goals. The architecture for our plan is developed over 20 plus years of working with 1,000 dentists and specialists. Now, enough about us. Let's get to today's topic. We're going to be discussing some tax tips and guidelines for 2021. With that, I am excited and honored to introduce to you two very special guests, Adam Reich and Ron Stallman with Hohnkamp Kruger & Company, coming to us with over 50 years of experience between the two of them. Amazing. Little background on Adam. As a general services partner, Adam draws on his experience in accounting and specialized services to provide dental clients with a comprehensive analysis of their business's financial situation. With his guidance, clients learn to use their data and to develop and implement plans for successful growth, financial planning, and transition. Thank you for joining us today, Adam.
Thanks, Eric.
A little more background on Ron Stallman. With more than 30 years of experience in public and private accounting, Ron has dedicated his career to developing solutions to suit the needs of each of his clients. With a specialty in dental practice enhancement, Ron's focus is on assisting dental practices with their unique business and tax planning needs from startup through times of growth and change and into transition and retirement. Ron leaves no stone unturned for his clients and ensures they have the best transition experience possible to meet their goals and time horizon. Welcome and thank you for joining us, Ron.
Thank you, Eric, for that intro.
Yeah, love it. Appreciate you guys being here. Adam, I'd love it if you could give us just a quick overview on Hohnkamp.
Yeah, you bet. First I want to thank you for using pictures from probably at least 15 years ago for Ron and I. The 50 years of experience isn't coming through on that, but we certainly appreciate your marketing team doing that for us.
Really can.
Yeah, Hohnkamp Kruger is the top 100 CPA firm in the country. We are based in Iowa. Our geographic footprint is Iowa, Illinois, Wisconsin, but we do business across the country. We are the #1 provider of accounting, tax, and financial services in the state of Iowa to dental clients. And as Eric said, the 50 years of experience, we do the best that we can to provide solutions to clients to problems that clients might not even know that they have. But we're looking out for them, looking forward thinking. It's very much what we're about.
Love it. Appreciate you sharing that information, Adam. You guys ready to get started on these questions here?
Let's do it.
Let's do it. All right. First one up is Qbi deduction. How does it impact dental practices?
Yeah, so that's a good question. First of all, QBI is Qualified Business Income Deduction. This is a Trump tax cut. And a lot of publicity when it first came out that says if I've got a flow-through entity, so a partnership, S corporation, if you've got an LLC, it's taxed as one of those two items. You get a 20% deduction on all your flow-through income, and everybody got really, really excited, saying I'm going to pay less taxes. Well, they snuck in there some language that for professional services, dentists, orthodontists, oral surgeons, that there were some caps on that and some caveats, and so we got less excited, but it creates some planning opportunities because we're not just completely kicked out. We've got some numbers here that we've got to hit. So as Eric put up here on the slide, if you're married and filing a joint tax return and your taxable income is under $329,000, you're going to get the full 20% deduction. So a couple key components here is taxable income. What that is going to be income from the dental practice. If you own the real estate, other real estate investments you might have, W-2 will basically take all of your income, stick it in a pot, and then we get to take off of that the standard deduction, the $24,000, or if you itemize, we get to reduce that income number, and that's going to get you to your taxable income. So when we look at all of those things pulled together, if we're under that 329, you are going to qualify for that 20% reduction on your practice income and your rental income from the building that the practice is renting if you own that. If you happen to be above those numbers, we're not completely kicked out just yet. We get to go from 329 up to about 429, about $100,000 spread there, where it phases out as we move up. So for each $1,000 that you move up that tier, it's kind of 1% of that 20% that goes away. So if you're over by 50,000, your 20% deduction is essentially down to a 10% deduction. And then if you get over that 429, then you get zero. And that's just the way they wrote the law. So we're going to go through some things here in our tax planning that's going to circle back to these numbers and say, okay, how can I manage my income to maybe get them down to, if I'm over that 429, can I get under it and grab some of that deduction? Or if I'm in that phase out period, can I maybe get down to under that 329 and get the full deduction? And this is eliminated after 2025. So we've only got a few more years here to take advantage of this deduction before it goes away. Now, obviously, we put the asterisks on there. There's an election, there's tax law changes and things that happen. But right now, this is what we're dealing with. And 20% is a big deduction that we can get. So we want to be cognizant of this. We're going to talk about ways to maximize this. And then, like I said, it's flow through income only. So if you have a C corporation, that's not flow through income. You're not going to qualify, and we can certainly follow up with you on maybe, do we want to go from a C corporation to something that flows through in order to get this deduction? But that's a discussion maybe for another time. So we're going to focus on these numbers here. How can we manipulate our income to get down maybe to some of these numbers and utilize this deduction? And I think Ron is going to be up next year and talk about some depreciation and how we can utilize that to help us manipulate our income for this deduction.
Love it. Appreciate it. That's great information. All right, Ron, I think this one, Adam says, is up on you. How does depreciation affect QBI, and how can it be used as a tax deduction?
Well, the key is we need to get our QBI income, taxable income, down to 329,000. So several ways we can do that, and one of those ways is investing in the practice. We can buy equipment. By buying equipment, we can actually, and this is nothing new, we can actually Section 179 it. So we can take it, deduct the entire amount in the current year. You know, most dental practices do not qualify or buy $1 million worth of stuff, but if you do buy $1 million worth of equipment, you're able to deduct $1 million worth of equipment. But what we look for in our planning sessions, Adam and I, is we look at the practice income. What's our delta to the income to that taxable income of $329,000? That's the amount of fixed assets we need to identify that we need to invest in the practice to qualify for this. I mean, some practices, I get it. You guys may go over the 325, but there's, just because you can do planning, maybe you qualify for this in one, or year 1 in year 5, or year 1 in year 4. If you buy enough stuff, if you finish out 3 ops one year and then you finish out 3 ops the next year, replace your entire fleet of equipment and computers and etc., you're able to save, for instance, $300,000. Take 20% of that. That's $60,000 free deduction. That free deduction means $40,000 to $50,000, or probably $30,000 of tax savings. It's a big deal. Bonus depreciation also qualifies. Yeah, what that does is you can, if your income's high enough, you can take a bonus depreciation on new or used assets, and you can drive the practice income to create a loss, and that loss will allow you to deduct your W-2 wages to potentially get you into the opportunity to qualify for QBI. So this is available, 100% available for new and used assets placed in service for 2021. You got to elect into that, you got to elect out of that, but each class of assets you can do. Another little secret thing that we talk about is real property. Real property is tangible real property you're building. Improvements that you put into the interior portion of your building would qualify for Section 179. Section 179 means if we remodel, dump $100,000 into it, we can write off $100,000 and do some proper tax planning, and you're going to be able to get underneath that and potentially get a QBI deduction. Does not qualify for bonus, however, but it does qualify for the Section 179 deductions. Now, enlarging the building does not qualify. Putting in elevators doesn't qualify. Adding a bunch of walls would not qualify. So it can't be structural, but it's got to be internal, carpeting, paint, and other improvements that you can do, replacing stuff. The key is to get your taxable income on or about to 330 grand. Another thing you can do is if you build a building, you could actually do a cost segregation study. By doing a cost seg study, you can take that 39-year property on the interior and maybe get that down to a 5-year or 7-year fixed assets, which then we can actually qualify and use Section 179 also. It's a big deal. You can take a 39-year tax deduction, get it for a 5 or 7-year equipment deduction, and we can maybe ease our way into QBI for multiple years on top of that. Eric, if you want to slide to the next slide, see what we got here. I believe it's Adam. This is another opportunity for you to invest in your practice and potentially qualify for QBI also.
Yeah, so we're oh, go ahead, Eric.
I was just going to say, yeah, the next slide up is I had the next question. Before we kind of hop into that, I just wanted to just bring up that real property improvement. That was actually really interesting because I think one important piece for dental practices is just keeping up with the times. I think it's just important as a brand, as just the aesthetics within an office, just those simple improvements that you can do throughout it can just make such an impact from a patient standpoint of just their overall experience of walking in the door through the experience with the team to walking out the door. And I just would imagine that a lot of folks out there probably don't even know about this existing.
Eric, I would say that probably 90% of the dentists that I talk with are not even familiar with this. Their local hometown accountant, CPA, who prepares their taxes doesn't even take this into consideration or educate the dentist. So yes, I think you're 100% accurate with that. I mean, the cost seg studies are around 6,500, give or take. It's a very reasonable cost in order to be able to take a 39-year building and turn it into a 5 or 7-year dental asset and get a great tax deduction on the meantime. It helps you pay for the building. It increases your cash flow immediately, gives you great opportunity to retain staff, keep staff, educate staff, retain patient base. It is a brand, and you're 100% correct. It's when that first patient experience walks in that door, what does it look like? And now is the time between now and 2025 to kind of think about stuff like this. Agreed. Thank you, Eric.
Yeah, it keeps them up with what we continue to see with these new ground up, these de novos, these brand new buildings going up. It gives existing practices an opportunity to kind of stay relevant to the times with, just with the way the world is and modern things that exist. Love it. Taught me something today. All right, next question up. How can dentists be best financially prepare for retirement?
Yeah, so I do want to point out one other thing that Ron had mentioned too, along with what Eric had just pointed out there. But Ron talked about maybe you do 3 ops 1 year, 3 ops the next year in order to kind of manipulate that income. It all goes back to planning. You can't just kind of do it and then say, does this work or not? It's having that strategy. It's having those discussions ahead of time. And as Eric said, you're talking about your brand, you're talking about, freshening things up. Well, with this extra 20% deduction, some of those things get paid for just by the planning side of things and qualifying for this extra deduction. So it's not even costing you anything to do it because you're getting a deduction that you normally wouldn't have qualified for if you go through and you do the planning and you do it right. So that would be probably one other thing that, and Ron made a great point of doing it, crossing maybe years and those sorts of things, but having that plan in place to maximize these things is just so crucial. And that kind of leads into this financially being prepared for retirement. And not just retirement, but it's just kind of that whole financial planning of life and doing what you love as a dentist, but being able to call the shots and do things on your terms. And if a COVID hits and you say, I don't want to go back to the office, I'm just not interested in that anymore. The restrictions are different and it's a risk to me from a health standpoint. Being in a position to be able to make that determination and not saying I have to work because I'm not financially ready to retire. And so we kind of get that aspect of it, as well as we're talking tax deductions, where again, we've got some big dollars here where we can manipulate that income. So, the first one that we're talking about is the 401k and the limits on the 401k. A lot of dental practices will maybe start off with a simple plan because it's easy to do, but the limits are lower. They're only 13,000 instead of the 19,000. So we typically will see, yeah, maybe you want to start that way, but when we start talking about manipulating income, you really got to get to that 401k. If we've got our spouse on the payroll, we can put 6,000 more away for us, 6,000 more away for them. We've now got $12,000 of tax deductions. So again, as we're trying to maybe go from, inside of that phase out period, well, we take $12,000 out of that. Now we're getting a double benefit. We're paying tax on 12,000 less dollars, plus we're getting some of that QBI deduction back. So certainly something that we need to look to. A lot of times younger docs will say, well, the simple plan, I don't want to do all that fancy. I don't want to put away, the next line shows 65,000 in a profit share. I don't want to do that. And I understand that. But you also have to understand the power of investing when you're young and how much that money's going to grow. The second thing is that in a simple plan, if you want to do a Roth IRA, you've got issues. You've got tax problems there. It's not the strategy. In the 401k, we eliminate those tax issues. Now we're getting 6,000 more a piece, again, husband and wife, into a Roth IRA. Now we've got $24,000 invested for us. If we do that for 20 years, we got $500,000 invested. Half of that's growing tax-free, half of it's growing tax-deferred. And when it comes to making these life decisions about when do we want to retire, we're going to have a much better nest egg than if we wait until we're 40 or 50 or 60 to try and do some of these things. So starting young, having a plan is crucial when it comes to this stuff. If you are a little bit more advanced in your career and you say, hey, Adam, I didn't get started when I was 30, help me out here. What can I do? Well, now we can layer on a profit share. And again, here's where we're talking about some big tax deductions where $65,000 for you and your spouse. Now you're talking about putting away $130,000, most of which is going to be tax deductible. So if you say, hey, Adam, I'm right at that 429,000. I'm going to get down to that 329,000. Is there a magical tax deduction where I don't have to give away my money? I get to keep most of it, but I can still qualify for this tax deduction. It's this profit share plan. You put $100,000 in a profit share. You've got to give some to your staff. Most of it's going to go to you. You've created $100,000 tax deduction, so you're paying tax on $100,000 less of income. And you went from getting zero QBI deduction to getting the full 20% QBI deduction. So again, very powerful stuff that's going to take a plan in place ahead of time to think through these things. And then as long as we're talking about retirement planning, we talk about maybe putting the kids on payroll. If we've got kids, we get them some income. We can put some money into a Roth IRA for them. That grows tax-free, which will have a huge impact if it sits there for 60 years for them. Or we've got opportunities like secondary education, first-time home purchase, where we can pull money out of that Roth IRA and utilize those funds for those objectives as well. So again, we're talking about how can we get big tax deductions? How can we grow financially so that when we maybe don't feel like going to the office anymore and it's time for us to be done, we can make that decision and not be stuck saying, I'm a slave to the job. I've got to keep working because I'm not financially ready to do that. These are some of those things that with a plan in place will help take care of those things for you.
Fantastic. Some solid information here, gentlemen. All right, next up on the docket, we have how can dentists qualify for the employee retention credit?
I'm going to go ahead and take this, Eric. I will say that there's a lot of CPAs that have missed getting this for their doctors. The new clients I've been picking up in the last couple months, I've asked the doctors if they applied for employee retention credit, and all of them look at me with a blank stare. What this credit is, it is a credit where if you were fully or partially suspended, all of our dental practices were to some extent. In Iowa, it was 2 months, Wisconsin and Illinois and Minnesota. You're partially suspended, you qualify automatically. If your business collections, not income, but your gross collections were down 50% 2020 over 2019, you also qualify. You look within the qualifying period, and if you paid wages, you automatically will receive an employee retention credit. What that credit is, it is 50% of the wages you paid on every employee during that qualifying period. Each employee can only utilize $10,000 of wages, so the maximum credit per employee is $5,000. So if I look at one of my practices in Iowa, we were suspended for 2 months. I pulled those wages for 2 months, and doctor paid $40,000 of wages, and that no employee was over $10,000. Your opportunity is, I think you got to throw out some employee. I guess the owners, do owners qualify, Adam? I don't think they do.
So if you're a solo practitioner or a partner that's unrelated, if you're unrelated, you qualify. But if you own together, say it's a husband wife, it's a brother sister, those don't qualify. It has to be unrelated partners of 50% to qualify.
So then those wages would qualify for the credit. How do you get the credit? You have to physically amend the 941s for 2020. So this example, in Iowa, we have a lot of amended second quarter 941s. And if my wages or my collections were down 50% over 19, then I can actually go into the third quarter and amend that 941. Now, here's the caveat. You cannot use the same wages for this employee retention credit with the PPP wage. So it takes a lot of planning. PPP was 24 weeks. Employee retention credits could be limited to 2 months or maybe 2 quarters. So you have to physically get the wages, map them out so you don't use that same $1 wages for PPP and ERC. And believe me, 95% of all the credits that we prepared, we were not using the same wages, and majority of the doctors fully utilize the employee retention credit available. I mean, some offices got 3,500, some offices got 15 grand. I would say $15,000 to $30,000 would have been a pretty good bucket full of my dental practices. I mean, I had a dental practice get 80 grand. So it's all over the board where these credits are at. It just depends on if that suspended period of being able to work, it depends on your decline in your gross receipts or where that spilled over. So that's kind of what the employee retention credit is. If you want to slip to the next slide, Eric, and we look at this, this also spills into 2021. We also get to utilize a new $10,000 per employee, but that per employee goes to per quarter per employee. So it's pretty powerful. The 50% of wages now goes to 75% of the qualifying wages. So significantly different. The gross receipts goes from 50% down to 20% down. Big difference. Another thing I should talk about is when you utilize the employee retention credit, the good thing is you're getting a credit. You're going to get free money. However, this free money, if you're amending the 2020 941s, it's truly 2020 income. So that's been clarified through the rules and the regulations that we need to, if we go back in there and you didn't do this, we're gonna have to go back and amend your 2020 corporate return along with your 2020 individual return. But again, it's It's free money. It's credit that you guys, that the dental practices deserve. And another thing, caveat is that if you didn't exist in 19, there's some rules and regulations out there where your practice could still qualify to get employee retention credits. So just because you don't know the answer, it might be worth calling Adam or myself in regards to getting some clarification in regards to this. It's a pretty big deal. And a lot of CPAs that are local are not on top of it. So that's kind of my recommendation for all the listeners out there.
No, I love it. It's great information. I can't tell you how many times through conversations in the last several months, maybe a little bit longer, I've heard from practices of just, we can't spend any money. We don't know how things are going to end up. It's been rough. Things are a little bit slower, but from what I've just heard you say is that this really helps counter that. If there are practices out there that experience that or are having a tough time getting back to how things were pre-COVID, there's a lot of credits out there that can really counter that pain that they're feeling to really help them get over that hump and get back to the way things were.
Absolutely, Eric. Good point.
All right, that looks like that is it for the questions. This is fantastic, Adam and Ron. Really appreciate you two taking time out of your busy schedules to educate us with the tax knowledge provided. Just a reminder to those out there that Adam and Ron are available for a complimentary consultation by contacting them directly at their email addresses provided here on the slide. And lastly, Medix Dental IT and I would like to thank you for joining us today. If you would like to learn more on how our IT treatment plan can streamline your practice's IT operations, you can contact me at eric@medixdental.com for a complimentary consultation as well. Just do me one last favor and make it a great day.